So I am going to be talking about today 3 signs of trend exhaustion. How many of you consider yourselves to be technical traders? Most of you? Okay, good. So when I first started teaching market analysis back in the 1990s, that question would be answered with a lot of more skepticism. You know, a lot of the focus was on fundamental analysis, especially if you said that you were investing in anything. And I remember one interview I did for CNBC, they were looking for somebody to take over like some of the slots for cancellations. And they're like, okay, so what can you tell me about the fundamentals of XYZ? And I'm like, I don't trade fundamentals. And it was like, what? What do you mean? But now it's pretty much par for the course, people coming into trading and investing. And I think the reason is that it's something that everybody can learn. It doesn't seem as overwhelming as fundamental analysis does. I came into trading with no history in finance whatsoever. I was actually an archaeologist, worked for the Office of the State Archaeologist in Iowa for about 5 years, and raised as an artist. So what caught my attention about the markets was that I could see patterns that were forming in the market. And basically it was just showing me a visualization of crowd action. And I didn't need any fancy technical indicators or analysis to learn how to read price action. It just took a little bit of time. So that was like the hardest thing for me, is just going in and trying to understand if my instincts are telling me something, is there a valid reason that my instincts are telling me, like XYZ is exhausted, I should start to look for reversals or corrections. But why? It's not enough to say, oh, I think this has gone up too far, so it should end. What reasons are there that we can actually see in any security you're trading that are going to indicate that, yes, indeed, we have market exhaustion happening here? And that's what I want to share with you guys today. It's just some of the core things that I've picked out of the markets over time, where we're going to focus on just reading pure price action. You don't have to know Bollinger Bands or stochastics or even how to read volume right now. We're just going to talk about looking at pure price action. So not only are we looking for 3 signs of trend exhaustion, but of course the most important part, how do you profit from it? All right. So I'm going to show you guys a couple of examples of trades that I've taken over the years, because the type of core market analysis that I do now is no different than it was 10, 15, 20 years ago, except now I know a lot more of the nuances, of course. Even in the last 5 years, I know a lot more of the nuances in the market and how to explain them to you folks as well, so that you can start to see them also. So what I'm going to share with you are a couple of trades from way back in 2013 and those exact same strategies that are occurring in today's market and how to differentiate. For example, you see this slide here. This was a trade that we had in the dollar yen. And you'll notice there's a lot of previous levels of highs that they all correct to some degree, but it's only this one that we see the really rapid, larger reversal and correction. So what I want to share with you is one core strategy that I use for timing some of these major pivots, and not only just recognizing when you can time a pivot to get into a reversal in the market, but also if you're already in a trade, how do you recognize that you should be taking profits before you actually start to see things pulling back on you. So those are going to be a couple of the things that we're going to be talking about today. So here's another example. This is, of course, one of the big ones from our weekly charts. And as folks like Donnie here knows, you know, we were talking about the market for a number of months heading up into these highs, but it's only this pure part of the market that really caught my attention. And I'm going to show you guys why. So we're going to be looking at it on larger time frames and also smaller time frames, like this last week. Why did what I was seeing going into that day indicate that we were going to be in scalp mode, that we should be looking for more of the back and forth action within the day versus looking for a pure reversal or anything like that? So to start with, I got to read this disclaimer here for you, at least show you this disclaimer. Blink, blink, right? Some people have like a horn that goes off. Don't trade with your college money for your kids or anything like that. Don't just jump into the markets and say, hey, I am fine. So everything that I teach you is based upon what I've called in the past my building blocks of technical analysis. So these are core concepts that you guys, even as a total layperson, should be able to walk out of this class and have an understanding of what those terminologies refer to. And not only what they refer to, but how to put some of them together so that you can actually see some of the signs of trend exhaustion. So the core concepts we're going to talk about today are momentum, understanding momentum, identifying impulse waves. These seem like really simple terminology, right? And reading trend development. Well, as any trader knows, you can take something that might look simple and then you're just like, I have no idea what to do. It looked really easy when they were reading the description in the book, but how do I actually apply it? So momentum, this is the first one we're going to start with, understanding momentum. So momentum is the rate at which prices in a security change. This seems like a very basic concept like gravity, right? And yet you have like certain people that are attributed as discovering gravity, like suddenly gravity came into existence. It doesn't happen like that. But when people talk about something, draw attention to something, you think about it more. So when I first started teaching technical analysis as a trader, I called this pace. I didn't know, what a good term for it was. It was how was the market price changing compared to how it did in the past. And I was completely flabbergasted that more people weren't talking about that. In fact, nobody was talking about it back then. But once you are paying attention to it, it's not something you can just ignore, throw it out of your brain. Once you start thinking about momentum, it's there. It's something you're going to constantly think about and look at. So when we're looking at momentum and looking at the rate of prices changing, when we're talking about average momentum, this is going to be something where you don't need to have any indicator to tell you what the momentum is. I want you to think of, on any chart, any market, look for a period of time in that market where you're seeing a lot of V action back and forth, okay? And where you see those V's and the inverse V's, generally speaking, each side of that V is what you can consider to be average momentum. So when we talk about trend exhaustion, we're referencing the difference between an average momentum move and a stronger than average or slower than average move. So if I'm talking about a faster than average move, I'm looking at something in the market that, generally speaking, is going to start to lead to slower corrective moves. If something is slower than average, then you can get these stronger breakouts from the zones of congestion. And what you'll notice here is that in each of these waves of slower than average congestion, there's stronger than average moves. So let's see if I can show you my marker here. There we go. Highlight it a little bit better. There we go. So you'll see these stronger than average moves on the downside, right? But I've marked this as slower than average. And the reason is that if you have two highs and two lows, you have a trend channel that's formed. And when I'm looking at that trend channel as a whole compared to the channel on the upside where I've got two highs and two lows, the overall momentum has now shifted. So as a whole, I have a slower than average pullback. But a lot of people get caught up in that last little portion right here, where it goes into strong drop mode. Never mind that it's the lower end of a parallelogram, which is generally going to be a decent level of support. They overlook the fact that this entire pullback, this entire correction, is going to be considered to be gradual and slower than average. Now, of course, if you have a shift in momentum within that channel, at one end of the channel, it can help with a breakout. For example, up here, we've got a pattern most of you would know as a head and shoulders. And at the lower end of that shoulder, you'll see that, clear this, it shifts momentum a little bit more. So even though you've got this whole channel zone of congestion, it starts to hug one end of that channel a little bit more. And that can give you a better heads up that that's the direction it's going to break. But what that does is mainly it just allows you to have a tighter stop than you would versus taking a stop over or under the entire channel. So when I'm looking at entering a position, let's say on the long side here, I'm looking for a move that is coming off the lower end of the trend channel that can break to the upside, or I'm looking for something that's hugging the upper end of that channel to shift momentum. And that's going to get me into the position early on without this massive stop, where a lot of traders are taught to take gains, which is, or to enter position rather, which is here, where you're basically looking at the full channel break. Well, by the time you hit first resistance, compared to where a stop would be, you don't have a lot of gain in there. So it's really important to start to recognize where in this channel do I have the best chance of a pivot taking place that is going to fully give me a strong directional move. And that's what we're going to look at here as the day goes on, the class goes on. So very basic idea with momentum. So here we are looking at this high on February 1st. And I run a live trading group. It's called Forward Focus on Fridays. We talk about what's going to happen in the market in the week ahead and why. And so going into Friday, we were looking at exhaustion in the morning. And one of the reasons we were looking for that exhaustion. Oh, sorry. This is a chart of, I think I had it mentioned on the previous page. We've got, oh, I guess I didn't. It's usually going to be about the 8,000 tick of the NASDAQ, probably is what we're guessing here. It's the overall market.
That's down right there.
Oh, sorry. Yes, okay. So we are looking at, sorry, I don't have my close glasses on here. We're looking at a move, though, in the overall market in the morning, going into the afternoon, and looking at not just the upside moves here that are stronger than average, but the overall shift in momentum of this channel. So I trade all of the futures kind of back and forth. Basically, I'm looking for, sometimes I'll actually split contracts between two different markets. Sometimes the market will give you a really clear clue as to which one's going to be the leader, and then other ones you'll have not as much of an idea which one's going to follow through as strongly as the others. So here is that transected channel showing you that larger shift in momentum I was just talking about. And a lot of times what will happen to give you some of the stronger breaks that'll be like the easiest ones to catch are you'll have it hugging one end of the channel over the other, and that's going to give you more of a heads up as to which direction that market's going to break. So even if you have smaller momentum moves that are really strong in one direction, you want to pay attention to what is going on in that transected momentum, and then drop down to smaller time frames. So a lot of traders will get stuck looking at what is happening on just the smaller time frames, and they lose track of the momentum shifting on the larger time frame. So it's really important that you're paying attention to that. So our first sign of trend exhaustion is that momentum shift. Here's the NQ on the daily time frame. So I was looking at basically the same pattern that we saw on the previous slide of the Dow. Again, I can't read my prices on here, but on the previous slide of the Dow, it's the same pattern where you're seeing that shift in momentum here. And then you get it hugging the smaller end of this range. So I was initiating shorts originally up at this high. We were even looking for, in our trading group, we were even looking for continuation of this move to this higher high and this exact high here. And this is what I want to show you guys today. How do you know that this is going to be the exact high versus something like here or here? How do you determine that this is your high and this is your pure continuation? So momentum is one key that we look at. Sometimes it's easier to see momentum shifting on a larger time frame than it is on a smaller time frame. So if you see the weekly chart here, you can notice that there was pretty average momentum on the upside all through April and May, basically the end of the spring here going into the summer, where you've got overlap in each of these bars to a pretty good degree. But if you were to look further past in time, you'll notice that this would be one side of what these average V's back and forth are. So if you can't get a feel for what the current momentum is based upon a slide that you're looking at, maybe you're in an uptrend, for example, go back to a larger time frame where you can actually see that V back and forth action to kind of put it into perspective for you. But you'll notice that a typical way an average trend move forms is you will have this overlap, a decent amount of overlap, and then you'll get some of these larger bars that are in the middle here. But it took this shift in momentum over here before we finally started to see selling. So at this level, we're dealing with resistance, previous highs, but it doesn't fully turn things around because this is still average momentum to the upside. So it takes that additional shift of slower than average momentum that helps lead to the stronger breaks to the downside. So here we can see this a little bit closer up. And now we're going to look at impulse moves. So there's a bit of an overlap here when we're talking about terminology because the momentum that we're watching is based upon these impulse moves. So here is a pretty average impulse move to the upside, another fairly average impulse move to the upside. If you see the V portions, for example, here, you can see that this momentum is pretty much the same both ways, both directions. So an impulse wave is the primary wave of directional price action. And what we are looking for to help us identify trend exhaustion is the size of the current impulse move that we are in versus other impulse moves in the past that had similar momentum. So when you're looking at an average impulse move on the upside, we want to compare that to previous average impulse moves in terms of the size of the move itself. So for example, here was the initial impulse move out of the open to the upside. Here is a zone of congestion, and then here's a secondary move to the upside. Same momentum, same pace or rate of change. So typically, you're going to look for resistance as it comes into 100% measured move of that previous impulse move. And this is where momentum really comes into play, because if this had a slower move coming out of that congestion, that shift in momentum can lead to an earlier reversal. It can have a harder time fully continuing. One way that you guys are going to see that happening is when this range breaks out, if it only makes it to about halfway, the previous impulse move, it only makes it up about halfway, goes into a correction, and then this period of correction lasts longer than you might have seen in the first upside move. Let's say it goes over to here, and then it tries to break higher. Well, if you transect that new channel, you've got momentum overall that's going to go more like that. So even though you'll still have some of the stronger impulse waves on the upside, like here and then here, the overall channel itself will have that shifted momentum, like we saw in some of the previous slides. And that is what is more likely to lead to some stronger reversals. So you'll notice that this one has the same impulse wave, very little correction. Kind of, I call it a kneecap. It's kind of like if you're looking at this as an entire leg, you just have like a little bit of a pause in the middle. And so that's what's going to give you pretty much close to 100% extension. And then you can watch for shifts in momentum on the smaller time frames to help you pull into these larger levels of correction and congestion. So going into this here, a little bit more detail, and we're going to get to pure strategies here in a few minutes. So I'm going to start with just giving you some terminology, and then we're going to dive in some strategy. So with these primary moves, primary impulse moves, what you're going to notice is that there's portions within this that have these surges of momentum, where there's basically no overlap or virtually no overlap in that move. So when we're looking at understanding trend exhaustion, if you go look at previous levels where you have these surges in momentum, and you're now, say, on the short side of this head and shoulders, and you're coming into about that same level in terms of price development and time development, that's one indication that you are coming up on an exhaustion move. Can it push a little bit further past it? Sure. A lot of times what happens though is the momentum's going to shift there. So if you're looking to get the largest portion of a move and need to pay attention to, hey, here's where I need to start to develop some closer market analysis, dropping down to smaller time frames, paying attention to some other things. Like you might have a swing trade on, for example, if this was a daily chart. You might have a swing trade on here, and you can't be like in the market the whole time. So you'll trigger an alert as this is coming and closing in on what is a typical impulse move in the past. And that says, yo, heads up, this is going to be exhausting soon. I need to go and start to pay more attention to what's happening on this particular trade now. You can also do the same thing if you're looking for a reversal in the market. So let's say, for example, you're looking for a short strategy, but things are right down here and you're seeing maybe a smaller time frame for a short, but you look at the chart and you realize, hey, you know what? Compared to previous impulse moves in the past, the short strategy that I'm seeing is not a full impulse move yet. And not only that, but the momentum is stronger than average still. So I will show you what that means here. Let's click this and switch to the next slide. So basically, when we are looking at these impulse waves, we're looking at the momentum moves, but we're also looking at the fractal nature of these moves. So we will see those smaller surges of momentum within each of these bigger impulse moves. And these are going to be really important as we look at managing trades and looking at for reversals and things like that, because it can prevent a lot of traders from capturing the most out of a move if they are looking for the core concept of, hey, I'm just going to look for a measured move. If you're just looking for a measured move on one time frame, you might miss out on the fact that, yes, this upside move here is similar to some of the previous impulse waves, but there's a lot more potential on that for upside because I need to pay attention to the larger impulse move that happens in the past. So a lot of traders, they get stuck on the smaller time frames. They'll see technical analysis that looks to confirm something that they're seeing on a smaller time frame, like an intraday chart. But they took a trade based upon a daily chart. Strong resistance or strong support that's happening on a daily chart. So they get overwhelmed by things like smaller impulse moves on intraday charts. So it can kind of prevent you from getting the most out of a bigger move. So it's really important to not just look at one time frame, look at multiple time frames and looking at all of them together. So when I talked about momentum changing earlier, notice that one of the things I said was that you can have something coming into a resistance level, and you might see a momentum shift on a smaller time frame, but if you go up to the larger time frame, it might look like nothing. You might not see any sort of momentum shift whatsoever. So yeah, you could be at really good resistance at that level, but you might be trying to short it like 3 or 4 times, getting stopped out each time before it actually completely reverses. Happen to anybody? Couple, yes. Yeah. So that was like a big thing for a lot of traders is you can recognize where support and resistance levels are a lot of times just by looking even at like moving averages or things like that. But how do you know if something is in an earlier stage of a bounce, like maybe here, and it's only going to give you a minor bounce and go and retest the lows, versus something here where it has a better chance of actually fully breaking out?
How many windows do you look at when you look at?
Sorry, what's that?
How many windows do you look at?
How many windows do I look at? Okay, so I have 3 monitors for my trading, and on one monitor I have just the bigger time frames. So if I'm trading, for example, most of my trades are in the futures market. I do a lot of gap trading when it's like earnings season, when there's more news coming out, things like that. But I have all the larger time frames up on the one monitor, and then my other monitors I have where I have the smaller time frames.
That's where you do the entry of the smaller time frame.
Yep, but
You use the larger time frames to see the overall trend.
exactly, right. So when we put all of these things together, what you're going to find is that it's not just one time frame that matters, it's all of the time frames. So when we're looking at impulse waves, one of the best ways that you can determine trend exhaustion is if you have an impulse move that is average to stronger than average, and then you get a continuation. When it hits that measured move with that same momentum, that is your trend exhaustion zone. Now, the market can react to trend exhaustion where you have these measured impulse waves in several ways. And this is where things start to get tricky, right? Because sometimes they can continue the trend. And in fact, continue it to a pretty good degree. So if you're looking at this move, it went another good 50 to probably say 61.8% for continuation. But in other examples of how the market can react, this is going to be your first way that the market can react to this measured impulse move. The second way it can react to a measured impulse move is it can go into a trading range. So back here, when it hits support here, it could have gone into a sideways trading range versus just creeping lower. The other way that it can react is to totally pivot. And this is what we saw happening in the overall market on the weekly timeframes and the daily timeframes. So here's the question: how do you determine if something is going to fully pivot? So you can actually buy the measured impulse move as a pivot trade versus whether it's going to go into a congestion or if it's going to continue to creep lower. Anyone have some ideas? What do you think I would need to look for?
What's your question again?
Okay, so there's three ways that a measured impulse move can correct. It can go lower, just shifting the momentum. So you have your measured impulse move here, and then it shifts momentum. You have where it can go into a trading range, like here, or you have where it can fully pivot. Anyone have some ideas how to determine which one it's going to do?
History?
That's like the $1 million question. Yeah.
History?
History?
Yeah, the past.
Sometimes, but really the key thing that I want you guys to think about here is to look up on the larger time frames. So for example, maybe the larger time frame has an impulse move in the past where it'll have these two-wave moves and it's this big. So if you see a smaller impulse move that stops right here, you still have this extra zone compared to typical past impulse moves. So you're looking at those major swings in the market like this. So for example, if this bounce here, right here, was a little bit shorter than the one right here, then that extra little room can serve as a magnet to kind of pull it a little bit further. So you might have things like moving averages that are serving as a magnet down here. You might have something like a bigger time zone that's serving as a magnet. Also, one of the key things that happens is that if this impulse move is not only stronger than average on the smaller time frame that you're looking at, but you also go to the larger time frame and it is also showing a much larger than average move on the downside, it has more of a chance to do the back and forth action where it can go to the slightly lower lows. Whereas if on maybe this is a tick chart and you look at a time frame chart and this is slower or average momentum overall into support here, there's more of a chance that it could bounce, go into a trading range without having to hit those slightly lower lows. So the fact that things are kind of pivoting around a little bit better as this goes into a zone of congestion, where we're getting some of the more back and forth movement within here, that is pretty normal action. But when we're looking at how to trade these, what I'm doing is I'm looking to first identify smaller momentum shifts. But if I only see that smaller momentum shift on a smaller intraday time frame and I can't see it on the bigger time frame, then that tells me if I can wait and get a momentum shift on the bigger time frame where I can see that slowdown on a larger time frame as well, I have a higher probability of a larger reversal. So here, is where I'm looking at trend exhaustion to begin, but I won't necessarily have a full reversal trade at that point. And if I do, I'm using trade management that's a lot tighter. Let's flip over here to the next chart. So the last core concept we're going to look at is trend development. And this is a trend pattern that you guys have seen probably numerous times in the past, but I don't focus so much upon three-wave trend development anymore. I think a lot more in terms of twos, because even in a three-wave trend where you have your one impulse move, your second impulse move, and your third impulse move, these are often broken down into, sorry about that, into these smaller trends. So you'll have two waves and two-wave correction, two-wave continuation. So when I'm looking to initiate a new trade, especially as a reversal, I'm going to be wanting to look at these levels here, 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 and here. If I go into a trade where I have a pullback after an impulse move, but this impulse move is only half of what a previous impulse move is, then I know that at this zone, I could have a bit of a correction and a continuation, but not getting another really big move. I want to think in terms of twos. So if I'm looking for an initial continuation, I want it to mirror that one that's happened just before it. And again, when you're looking at smaller time frames, this is where you can get lost, because you might see that measured impulse move on an intraday chart, and so you buy it here, you get out. You know, here maybe you've got a small two-wave impulse move here, and then you've left a lot more on the table because you really have a bigger impulse move that is a two-wave move back here that gives you a larger target. So after three waves, this is where things start to have a harder time. When I'm looking at trend development and I'm looking at three-wave trend development, I'm paying a lot of attention to the amount of time that takes place in the middle here. So if I have a 30-minute correction here, a 30-minute correction here, and then this corrects another 30 minutes, another buy signal here is more likely to fail, because this is actually the zone where the trend is now exhausted, and we have a better chance of reversal patterns starting to happen. Let me show you guys putting all of this stuff together here. So, for example here, this is the larger market coming off of the lows. From our lovely sell-off on Christmas Eve, we were right smack into 50% retracement back into the 2016 lows. So this low was a really key technical support level. And you'll notice there wasn't much of a shift in momentum at that low. It just kind of did a really rapid pivot. So this is one of those ways that those corrections to support happen. You have that measured move right here, right into the support. And in this case, we had a really strong immediate pivot. So if I'm taking something that is pivoting off of a low, I want to get into the trade and see immediate reaction. If this stumbles maybe a third of the way up, I'm going to have more of a chance that it could even go and retest the low and shift the momentum and do that shift to those lower lows before it turns around. So when I'm trying to take a pivot trade, I want to get into it really early on, but recognize that maybe the 50% retracement level is down here. So there's a little bit of a magnet for it to go to that level. It has to bounce immediately. If it does not bounce immediately, I'm going to get more aggressive in my trade management. So I'll take some gains off faster. I'll look instead for places that I can add back into a position if it does start to shape up a little bit later on. But I'm not going to say, oh, I'm just going to hold it and hope it doesn't stop out, because there's going to be more of a chance that that can happen. Once this makes it past about the 50% point of this move down, though, you're pretty much clear. You have less of a chance that it's going to come back down here and do any sort of those retests to kind of flush you out. When we're looking at the trend development, though, you'll notice as this gets over here, we have one zone of correction, two zones of correction, three zones of correction, all last similar amount of time. At this point, I was telling folks that I needed to look for a longer period of correction in the market, because we have the three waves up. Each of those has these sets of two, two and two, two and two. I'm not drawing very well here, huh? drunken mouse here. But with each of these series, the momentum is shifting. The first 2 waves up is really strong. Second, shifts momentum here. Third, really big shift in momentum to start with. It kind of tried to redeem itself here, but that completed the 3 waves up. So by having the same amount of time for correction, you can see it triggered a buy here. But it didn't really go far. So after this third move, where again your correction time is about the same, that's going to show you that exhaustion is set in. And this is going to come into play when we look at our examples here on the trades. So let's flip this on over here. And these are just some of the pivot levels that I've targeted in my live training room, in my trades. And we're going to look at why some of these held and led to reversal. So I'm going to show you the last one here. And this is the one right here that we're going to look at in some more detail. Notice on every single one of these, though, we're looking at these 2 wave moves. And this is what's giving me a heads up. So I don't even have to dive down into the smaller time frames to know that I've got resistance hitting at these levels. It tells me, hey, it's time to go and look at the smaller time frames, to look for setups now, because they're at a good level to go and flip and turn around. So the main strategy I want to share with you is called a momentum reversal. So we look for a momentum reversal when you've got the 2 measured moves on the upside, and then go and drop down to the smaller time frames. Look for these V's to again take over. This is that shift in momentum on that larger time frame. So you might have smaller time frame setups right in here, but it doesn't manage to fully lead to a reversal. It just has like the small minor correction here. And that's because if you look at the bigger time frame, you can't see the shift in momentum yet. So once that shift in momentum starts to show up on a larger time frame, that's going to help you identify some of the stronger setups. Doesn't mean you can't have setups earlier on, but you want to realize that that is a more aggressive type of trade. It can more easily pull back, go to slightly higher highs. It could go into a flat trading range, or it could do the V pivot, but it basically can do any of those 3. Once it shifts momentum a little bit longer, and you have a series of 3 highs, you're more likely to get some of the stronger follow through on the downside, where you can get a larger main core reversal. So in that pattern, what I look for are these V's at the highs that is shifting that entire momentum. Then I'm looking for 3 highs that are pretty close together. And this comes back to that trade that I showed you guys back from 2013. Exact same pattern. We have 3 wave trend move up, kind of exhaust the main trend. Then this third move has another 3 waves. And then we get these corrections, 1 and 2. Even spacing between the highs shifts the entire momentum. So you're originally seeing exhaustion hit right here. This is your first sign of trend exhaustion, because at this point you have these measured impulse moves really similar to previous impulse moves. But it doesn't fully turn around there. It gives you a little bit of a correction, but it doesn't give you a really strong drop. So when I watch for V's and inverse V's that are forming like these little mountains and valleys, and I get 3 of them in a row where the timing between each of those 3s is about the same, that is going to be the level that I want to look for the reversals. And we can go and at this point even drop down to smaller time frames. I'll show you what that exact chart looks like here in a minute. But here's a short I had just as we headed into the weekend. This is the same pattern that you guys see on the dollar yen here. This is a 90-minute chart of the dollar yen, and here we've got an 8,000 tick of the NQ. So again, you've got the parallelogram with the shifting momentum compared to the upside and the 3 evenly spaced highs. So a lot of times that third high, what you'll notice on even here, on the dollar yen is you'll get the high and then you'll get kind of a slight retest of the high. This is where it's important to drop down, and once you're coming into the zone of that third high, go to the smaller time frame at that point, because now you're in like that key do or die area. So you can drop down to the smaller time frame to help you with the timing at that level. For example, you can see like additional smaller shifts in momentum at those highs. So this one, actually, this is an 8,000 tick chart. So this is your ES. I went down to about a 500 tick chart on this one, and you can't see this here very easily, but at this point, you actually have a two-wave move up right here, where there's two measured moves here at the highs. And so that triggered the main setup there on the short side. You get a little bit of a continuation with a continued shift in momentum right here that adds that extra confirmation. And that's what brings this through to a larger correction than each of the previous ones. It also is your most probable correction if you're looking for a larger trend reversal, for example, versus the initial ones that might be measured moves on the larger time frame and yet doesn't fully turn around. So here's an intraday chart showing you that dollar yen, and you'll notice the smaller time frame. Here's where it had that third leg. This was the third leg up. Measured move into that third leg, shifted momentum. But you can't see that shifting in momentum on the bigger time frame. It just looks like a pivot. Once you can start to see the momentum shifting a little bit better and you get that measured move there, that's what's triggering the short. You've got the change in momentum, you've got your measured impulse moves, and you've got the trend development with the two waves. So that's going to give you your full larger trend reversal. And if you're long, for example, if you bought it in here, let me erase this there. If you bought it here, just on the intraday, smaller time frame, that would give you your target level as well. Same thing here. If you were looking at this on the long side and you see two measured moves on the long side, that tells me, hey, I need to be looking at that zone to take my gains. All right, same exact pattern on the dollar Swiss here on Friday. Again, bigger shift in momentum, three evenly spaced highs. But if you look on the smaller time frame, you might see those three highs and only have it go to slightly higher highs again because it takes the larger time frame shift in momentum to really turn around. So if you see something forming on a smaller time frame, make sure you also see that momentum shift on the larger time frame before you look for a pure reversal on it. All right, guys, your core concepts: momentum, impulse waves, and trend development. So what I've done for today's session is I actually have a longer version of this that goes into a lot more detail that we put together for the Orlando Expo. And you can pick that up for $29 if you go to tonihansen.com Orlando/Orlando. So it has a more in-depth version of today's class, goes into a lot more of the details on the exact trades, and it includes a printable version of the PowerPoint as well, so that you can print that out, go back, rewatch the class, and take notes on it. So that one is actually well over an hour versus our 40 minutes or so that we had here today. So I recommend, if you're interested in reading pure technical analysis, not relying as much upon a lot of indicators to help you, but using the indicators just as like a little bonus for visualization, but understanding how to read the pure price development to show you the trend exhaustion. Go pick that up, and you can ask me any questions that you might have as you work your way through that course. But it is laid out very much from a beginner standpoint into an intermediate to advanced standpoint. So if you're coming in with no knowledge of technical analysis at all, I walk through things very slowly and concisely. So I know we've got a wide range of experience here, but do you guys have any questions? Yes?
Can you elaborate